We've got some headlines right here at home. The Nigerian Exchange has reassured investors that the exchange will continue to monitor trading activity to ensure market integrity and compliance with the exchange rules. The announcement came as the NGX suspends trading on the shares of newly listed Ziches Agro Allied. And of course, the NGX also remind investors to do due diligence on the back of significant price movement noted on the shares of some companies in recent trading sessions. But there is more to discuss on this around the central bank rate cut also on Tuesday as the exchange rate market behavior. We'll bring that also on board. Let me bring on my guest in our Abuja studios, Johnson Chukwu, the Group CEO at Cowrie Asset Management. Good evening to you, sir. Thank you very much for joining us live this evening.
Good evening, Boston. Thank you for having me.
Thank you so much. We appreciate it. What's been driving the stock market red hot in recent weeks, especially since we started the new year? Even though we know that the market was red hot last year, but how that came and January just continued roller coaster until where we are right now.
We're boasting a number of factors, one of which is a lot of liquidity in the economy. Two, we have boosted confidence, investor confidence in the market. And then the third factor is that this year, a couple of weeks ago, the pension fund came up with a revised regulation allowing pension fund administrators. PENCOM, Pension Commission, came up with a revised investment guideline allowing pension fund administrators to increase their investment of the several funds in the equities market. And that also injected a lot more liquidity into the economy, into the equities market, or created more latitude for pension fund administrators to invest more in the equities market. So these three factors, well, the performance of the underlying business, a couple of businesses have shown improved earnings in Naira terms. Two, we saw a lot of investor confidence boosted by the performance of the market last year and the preceding year. And then we are dealing with a lot of liquidity in the economy, looking for investment outlets. And the equity market seemed, given the performance of the equity market, that they had actually outperformed every other market investment class in the economy. So those are the factors that are driving up interest in the equity market and driving up the market to the point that as at the close of business, we have done more than 26% year-to-date capital appreciation or market appreciation or index appreciation on NGX.
Oh, great. So you're talking about what you call the market fundamentals, and then you got the fundamentals of the economy, you got fundamentals of the market as a whole. Then we talk about the fundamentals of the companies listed on the exchange itself. So there are three fundamentals here. So you've talked a little bit about the fundamentals of the economy itself, which are the reforms, the stability in the FX market, in the exchange rate market. Then we'll talk about the fundamentals of the market itself, the equities market as a whole. Then we'll go down to the fundamentals of each of these companies that are priced on a day-to-day basis by you, market and licensed registered professionals. So let's talk about this fundamentals vis-a-vis what you see in every market, which is speculation, whether it's currencies market, oil market, commodities market, whether you're trading gold, whatever you're doing, there's always speculation.
Well, Bossy, let's start from the fundamentals of the macroeconomic environment. We've seen a stability in the macroeconomic environment. You've seen inflation rate drop to 15.1% in January. We've seen even month-on-month inflation at a deflationary level of 2.88% deflation. So in terms of price levels, we are seeing stability in price levels. Second factor, we've seen appreciation of the local currency. We have not only just seen stability in the exchange rate, we've seen appreciation of the exchange rate over the past couple of weeks. We saw Naira test in the region of 1,350 Naira at the parallel and the official windows. So that is a contributory factor to the confidence of investors to invest in the market. And then you also seen improvement in the corporate earnings so far published. We've seen improvement in benefit declaration among the companies that have published their accounts. So those are factors that are flushing into the confidence of investors to come to the market. So you see a more stable macroeconomic environment, lower inflation rate, lower exchange rate. Of course, we don't have the figures for GDP figures, GDP for the fourth quarter last year. But even if you look at the first 3 quarters of last year, GDP grew about average of 3.78%. The last 3 quarters of last year. So that's also driving confidence in the market. And this factor, bear in mind that our foreign reserve has grown from the CBN figures, CBN governor statement of yesterday, to $50.45 billion. And that gives not just confidence to foreign portfolio investors, it also gives confidence to Nigerian local investors to say, look, I can invest in Naira instruments and not be worried that Naira will depreciate. So what we are seeing, because of the stability in the macroeconomic environment, we are seeing investors underweighing their portfolios in fixed income, foreign currency instruments and overweighting them in local currency instruments. Because Naira is appreciating, people are exiting dollar positions and buying Naira assets. And another factor you have to bear in mind that the equity market has outperformed inflation rate, has outperformed yield in the fixed income space, and has outperformed even what you may call average return from operating companies, operating businesses, which in Nigeria have been clustered around 30-35%. So last year, the equity market performed better than that. This year, we're talking about 26% in just about 6 weeks to 7 weeks of this financial year.
So when we talk about speculation in terms of trading on the market, what does that really mean? What should investors know? What should they be aware of?
When we talk of speculation, it just basically means people are taking positions, making investments based on what you may call the trend, the direction of activities. So because a direction, prices have moved in a particular direction, they begin to speculate or expect that prices will continue in that direction. And what is happening today, which is a contributory factor to the kind of market activity we are witnessing, is because speculation has kicked in. And speculation is basically, I have seen movement in this direction. I expect this trend to continue. I've seen gains in this particular stock. I expect similar stocks in similar industries to also appreciate. I've seen this company record 30%, 40% capital appreciation. I also expect another company in the same line of business to record that. So we are now dealing with what we may call technical analysis. People are following a trend and making judgment that that trend will be sustained. And that's what is happening, because if you even look at some of the stocks that have gained materially, they are purely based on speculative assumption that because they were penny stocks and the other stocks have gained achieve a particular threshold, this other stock will also achieve the same threshold, without looking at the fundamentals, without looking at the capacity of those companies to actually make profit or any improvement in their earning capacity.
Speculation, broadly speaking, is a general market behavior, isn't it? So if the big banks do well, absolutely, we could as well say, well, the other banks need to rub off on they said the big man's dog is a big dog. So if a big man eats big food, well, the dog under the table would also be big. You expect it to be big. So there's nothing really wrong with speculative trading, isn't it? But when we come to insufficient free float, which is an issue in some on the streets as to concerns about whether there's enough free float. Talk to me, what is free float, by the way, very simply put, so that I get some of my viewers to understand that. Then how does that relate to moving prices, whether you have sufficient liquidity in terms of stocks to move prices?
Okay, let me start from the issue of free float. Free float is what is the normal volume or percentage of a company's listed shares that are tradable, that are easily available on the floor for people to trade. The NGS has a defined threshold that says you must have a minimum of 20% of your shares that is available for people to trade in. So that way, there is a reasonable level of liquidity in that stock that you don't see unusual price movement just because people are trying to buy and there's no supply. So that's the issue of free float. But the other issue of our speculation, every market has speculators, be it FX market, be it commodities market, be it whatever market you have. You have what we may call gazes, where people think because a particular trend has happened, a particular thing has happened, they expect the next thing to happen. Because it rained yesterday, you think it will rain today. That's speculation that it's going to rain. But the key thing I must say is that when it talks of speculation, speculation must be moderated by sound analysis, sound and fundamental review of the capacity of that entity to make money. Because that's what we talk about. When you talk about speculation, you talk about what I call the 3 I's. Those 3 I's are, you have the initiators, those who think this company has fundamentals, and then they take positions and then profit. Once that happens, you see the imitators coming. There's a second I. The imitators will come in and say, look, because Bose has made 100 naira from this stock, then let me go in and make under, expect to make 100 naira. Then you come in, and then the imitators will drive up the stock price to a particular level that is no longer supported by any fundamentals. And then the idiots will now come in. That's the 3rd eye. When they come in, they are left with the tail end of the stick. They are left with the can of worm, because at that point, the stock price has moved beyond the level that can be supported by the fundamentals or the earnings of the company. So you have the initiators, the imitators, and the idiots. You must make sure you don't jump in when you are among the idiots.
I'm going to fact check you if I made 100 on any stock. But you got to go to the fact check to fact check that if I did. But well explained. So speculation is that shouldn't just be too much, shouldn't just be a bandwagon effect. So do you agree then with the NGX issuing an alert and say, look, investors have to do their due diligence and then they try to avoid speculative trading based on what you call rumors or hearsay, you know, what you call the locker room conversation among the boys, as it were. So a beer parlor conversation around stocks. Say, well, you drink a bottle of, you had to have a bottle of Double 3, I'm having a Champion Brewery, you're drinking Guinness or Nigerian Breweries. You say, oh, I think Guinness, Nigerian Breweries shares will go up.
Well, Boston, I think what NGX did is what you expect a responsible market operator, market regulator to do. Principally because if you do not sound that note of caution and the market continues to move in a direction that is not supported by the fundamental, then a bubble will be created. And that bubble, when that bubble is created, the bubble will one day burst. And when that bubble bursts, then the entire market will suffer. Investors will lose money. If confidence in the market will be deflated, and then people will pull out of the market. We witnessed that in the past in this country, where because of the expectation, because of speculative investments, people expected stock prices will move. I remember one particular bank that the MD used to say that the bank stock had not gotten to $1 and that the bank stock was going to get to $1. But that $1 then was about 108 something naira. But it never did because it was not supported by any fundamental. So it was necessary that they sound that note of an alert. And they also referred investors to always consult their stockbroker. So they are free to come to us, Cowley, and they will give them some of them free advice, pro bono advice on what not to go into. The reality is that it is not every stock that you should buy just because the other stock had gained. The fundamentals of the stock may be completely different. One may be a market leader. The other one is a market laggard. One may actually have created improved capacity to generate revenue. The other one has not improved any capacity to generate revenue. The key thing about that, the growth in equities prices should be driven by the growth in the earning capacity or the prospect of growth in any capacity of those underlying companies. If it's not supported by any improvement in earning capacity, then it's pure speculation. Then you are going to end up with buying stock that are overpriced, where earnings per share becomes inconsequential, earnings yield becomes inconsequential, and when you get trapped in that, you want to sell. When many people are trapped there and they want to sell, you say oversupply, nobody wants to buy, and the stock price will crash.
Yeah, I love the three I's. You talk about the initiators. Those are the guys who make money first and hand over the middle of the carrot to the imitators who thinks there's still so much left of the carrot. And then the idiots pick up the short end of the carrot where the stick is. And that's when everybody's made money and gone away. I love the three I's. I'm putting that somewhere. So yesterday, you've always advocated. You spent most of the last year in our conversations at every central bank over the last 2 years, the central bank monetary policy that there should be a rate cut, there should be a rate cut. So Cardoso delivered the 50 basis points to the rest of his team yesterday. So what's the market saying on that? What's the thinking of the market? What's the message of the market on that today?
Okay, in terms of the fixed income market, we are still watching to see how the market will react. In terms of the equity market seems to be dealing with other issues, particularly the advice by NGS that put some level of caution to investors' exorbitant appetite for stock. So it didn't reflect in the equities market. But the key thing we must bear in mind is that it has become absolutely necessary that the Monetary Policy Committee reduce the interest monetary policy rate. The simple reason that the monetary policy rate is supposed to be the anchor rate. Today, there is complete disconnection between the anchor rate and market rate in the economy today. If you look at what are the factors that drive the anchor rate, that's inflation rate. It is inflation rate that should drive the monetary policy rate. Inflation is at 15.1%. Anchor rate is 26.5%. If you look at return on yield on treasury bills, yield on 364-day treasury bills is in the region of 16%. Yield on even 2035 federal government, but it's about 15.4%, 15.5%, or in that region. So what interest rate is aligned to the monetary policy rate? Today, almost nothing, other than maybe the asymmetric corridor of plus 50 and minus 450. And the question is that even the plus 50 minus 450, are banks using it? Why would any bank go to central bank and borrow at 26.5% plus 4.5%, that is 31%. No bank will do that. The bank will go to the bank market and borrow at far less than that. Neither will any bank go to the central bank, and I'm not sure the central bank want to take deposit from any bank at 26%. So that anchor rate is no longer relevant given our current interest rate environment, given the current inflation rate. So I think the central bank has to do a precipitous reduction in the monetary policy rate so that make it to restore its relevance in determining the anchor rate in the economy.
All right, interesting. Well, what's the latest? What's the news on the street regarding the state of the Naira? And then just on the time we have left, in relation to the stability of the exchange rate, the central bank is said to be intervening in the market a little bit to try to rein in the Naira within a band that will remain very comfortable for foreign portfolio investors while things liquidity are managed in the system moving forward. How much of this do we know, and how much of that is our investors thinking about just as we begin to see the political election spending, the central bank sounding a warning, the monetary policy sounding a warning on that ahead of the elections next year, around this time next year, by the way?
Yeah, you know, bossy, last week I was on a program, on a webinar, and I said that the central bank should intervene in the market by buying FX to ensure that the rate at which Naira is appreciating is moderated. And the simple reason why it has to moderate it, I think the central bank has reversed that role, because when the central bank came to the market and said, look, we're going to sell FX to the BDCs so as to narrow the difference between the official rate and the parallel market rate, we saw both markets appreciate to almost approaching 300 Naira to $1. And the concern I had was that if we allow the Naira to continue to appreciate, which it will ordinarily give all of us improved purchasing power, there are implications we have to bear in mind. One is that the positive balance of trade we're enjoying will narrow. Simple is that because as Naira strengthens, import will increase. So if import increases, the benefit of having an accrual into the reserve on a sustainable basis will be moderated. The other factor we have to bear in mind that because we are seeing an appreciating Naira and the high yield on interest rate and an environment where global central banks have actually started loosening, loosening, then what was happening is that we are seeing foreign portfolio investors aggressively bid up for our Naira instruments. If you look at the capital importations at the end of third quarter of last year, of the 16.3 $7-8 billion that came in. $14.25 billion of it was capital importation related to money market or portfolio investment. Money market was about 10 billion of that. And then bond was about 2 billion. And then the rest was equity. So if you look at that and you consider the fact that, look, this are hot money that are flushing into your reserve. If you continue to attract hot money, then what happens is you're going to build up reserve. The political environment could trigger an outflow. And if it creates a panic, you are going to see a precipitous erosion in your reserve. You're going to see an unexpected depreciation of the local currency. So I felt that the appropriate thing for monetary authority to do was intervene in the market by buying dollars to stabilize the HID within a band that will encourage export as well as discourage frivolous importation.
Interesting what we're seeing right now. Do you agree that there should be a little bit of a caution, just to summarize and wrap up with you, thank you so much, that there should be a little bit of a note of warning or caution to the political class not to torpedo the outlook that the MPC presented yesterday in terms of the stability in the exchange rate, the Naira, and things like that, and not expect much liquidity in the system? Was that in order?
Yeah, Bosen, I think it's necessary we communicate that in strong terms. The greatest risk we have to the macroeconomic stability we're witnessing today is the political environment. Depending on how the politicians play the politics, if they overheat the polity and increase our sovereign risk related to political risk, then it could lead to portfolio investors leaving. It could lead to people taking position in FX to protect themselves. And then everything we have gained, because once you see a material depreciation of local currency, you're going to see a reversal of the gains we are having in inflation rates. Inflation will also reverse and begin to move northwards. So we must ensure that we continue to drum it into their ears that, look, it's necessary we have an electoral system that presents a free and free option that will give the people the confidence and will give people assurance that, look, the election is going to be free and fair. The winner will be allowed to take office, be it the current president or a new president, will win in a free and fair environment, and then that will help us sustain the current macroeconomic environment that we're enjoying.
All right. Thank you so much. Johnson Chukwu, Group CEO at Carrier Asset Management. Thank you so much for those market insights as always. Do have a pleasant evening there in Abuja. Thank you so much. We appreciate that.